Hi everyone, welcome to today's option trading lesson. Today I'm going to show you everything about option trading, and I'm going to really boil this down to a much more beginner level. So if you never knew what options were and you're interested about options trading, this is the right video to look at. Okay, let's get started. Now, why do people trade options? This is what options look like when you have a chart software. Well, one, because it's cheaper. In comparison with stocks or other sorts of ways of trading, option trading gives you the ability to buy sometimes a contract that costs $15 or $20 or even less, and you're able to make a lot more money with that. You're able to make sometimes 3 times, 4 times of that. With $20, you can make $100. Sometimes with $10, you can make $60. It's hard to do that with stocks. At least it takes, quite a bit of time. And that's the thing about options too, that they're very quick because of the way how options work. You can buy an option that costs $20 to $30, and in the span of 3 to 4 days, that $20 to $30 can go up to $60 to $90. It's very quick. There's not a lot of assets that can do that. You can't really do that with futures. You can't do that with Forex. You can't do that with stocks. Crypto, it depends, but there's a lot of risk. There's a lot more risk, a lot more fundamental analysis with that. In this case, option trading, you don't have to have such an enormous fundamental analysis. It's just that the way how options work, they're able to perform with quicker rates. And because of that, options have an exponential growth rate. With an option contract, as I said, you can make rocket gains a lot of the times with such a cheap price. So it's very cost effective. You can be able to make a 500% return at best. To be normal, you can make a 100% return, a 200% return on a lot of different strategies. And that's what makes it versatile with those gains. Now, with that in mind, what's an option precisely? Well, an option is a derivative of an asset, let's say a stock, where buyers and sellers are binded by a contract. The buyer of a contract has the ability to buy or sell the underlying asset at a time and price. The seller of a contract has the obligation, on the other hand, to buy or sell the underlying asset too at a price or time. Now, looking at options precisely, in options, you're always going to see two things, and they're calls and puts. A buyer and seller will utilize always calls and puts, but the way how they use it makes them different. When we look at calls, a call allows traders to sell their shares or quantity of that asset at a certain time and price. If you're a buyer in calls, buyers of a call will be able to bet on the upside of the asset being tracked. So if you're looking at a stock and that stock goes up, that call option under the stock will increase in value. And so the buyer also has the privilege to sell their shares if they wanted to at a certain price. Now, if you're a seller for a call, sellers will be able to bet on the downside of a stock or asset. As the stock goes down, the investment that seller made increases, but the seller, in comparison with the buyer, is obligated. They don't have the option, but they're obligated to sell their shares at a certain time or price if those options pass a certain time. Now, that sounds maybe a little confusing, but just keep in mind that what's important is that a seller is just obligated to sell a share at a certain time, right? So if a certain time passes, they're obligated to. Now, a put lets traders to buy their shares or quantity of that asset at a certain time and price. Buyers of puts will bet on the downside this time of the asset being tracked. So if the stock goes down, the put option will increase in value. The buyer also has the privilege, like in calls, to buy their shares. So instead of selling their shares for calls, put buyers have the privilege to buy their shares instead of selling if they wanted to at a certain price. For puts in sellers, sellers will bet on the upside of that stock or asset. So if the stock goes up, the investment of the seller increases. The seller is obligated to buy their shares at a certain time or price if those options pass a certain time. Okay, so that's pretty much the fundamental basics of understanding calls and puts. However, you might be thinking, how do we use options? Like where do they come from? How can we use them as traders? Well, in order to use options, you need to connect with yourself with a broker, and that broker has charts. So A lot of people use Robinhood, they use Webull, they use E-Trade, they use Fidelity. There's many different brokers out there that offer options, but the broker that I prefer is TD Ameritrade, which is now owned by Charles Schwab, and it's because TD Ameritrade has a really good software called Thinkorswim, which allows you to buy options at a lot more advanced way compared to any other broker. Now, I'm going to show you how to open an account with TD Ameritrade very quick. So in order to open an account with TD Ameritrade, and let me just do this in incognito, you can type in TD Ameritrade. Once you type in TD Ameritrade, you should be sent to this sort of page. So let's just click right here, right? And then once you see this, you want to click on open a new account. So because TD Ameritrade is now owned by Charles Schwab, you have to open an account with Schwab. So it shows that here. Now, depending what criteria you want to do, this depends, which I recommend to get more research about this, especially if you really don't know what to do. You can contact maybe a financial advisor to help you with this. But look, if you're going to just trade, this is my advice as swing trading, and if you're going to trade with options without holding them for such an enormous amount of time, I really just recommend to just open an individual brokerage account, because these other accounts are meant more for an investment sort of portfolio, and it doesn't really make sense. Like you don't have a much flexibility with buying and selling orders in the case that many people use in the way how I can teach you. So the best approach would really be to open a brokerage account. Now, once you click on that, you should be sent to this page where it says opening a new account. And really at this page, they're going to just ask you a lot of questions. So this just gives you a review what an individual broker account is. You can view this, but I already explained to you what it is. So let's get started. Now, this is just the basics. You have to fill in your first name, middle name, last name, and what your address is, your date of birth, social security. Now, let's say that, you enter whatever here, right? You enter your name. Let's say, I enter my name, Santiago. I enter my last name and suffix. That's optional. You don't have to enter anything in that. So is your current home address in the United States? This depends, if in my case it is. You enter your date of birth, right? And then your social security number. Now, if you are not located in the United States and you click no, it will then process you through another application. So I'm going to do this really quick so I can show you for the people who are not in the United States. So this is the international account. To be honest, I would highly recommend you that if you are not located in the US, to just contact Charles Schwab and that they can guide you exactly what you need to do, because I don't have a whole lot of experience towards a lot of foreign accounts that you can use, at least for TD Ameritrade. Now, if you are a foreigner, I would say that based on my experience and what I've heard from other traders, really the best brokerage account that you can use is for foreign accounts, if you're not in the US, would be Interactive Brokers. Interactive Brokers also offers options, and you can open an account with them. And it's really the same process as Charles Schwab. They're going to ask you the same credentials. But the benefits about Interactive Brokers for foreign accounts is that they're a lot more attractable tax rates, and there's just better accessibility towards foreign accounts. Now, the reason why I just highly recommend TD Ameritrade, whether you're a foreigner or not, is just because of the charts platform. So in this demonstration, I want you to just follow with me, because even if you don't trade with Thinkorswim, it doesn't matter, because in Thinkorswim you can use at least the analytics part and you can use the charts. And if you do want to actually trade with options, you just use on the side on another window Interactive Brokers. That's the way how I would do it if I were you. Okay, but back to this, you enter your account whether you're international, but in this case, because I'm not, I click yes. You just enter your date of birth, your social security number, and it's going to ask for the email and phone number. Okay, so I'm just going to enter this very quickly. All right, so because I already have an account, it's going to ask me to enter a new login. However, I'm just going to give you some basic things that I know. So I know that once you enter your credentials here, it's going to ask for regulatory checkments. So it's just going to ask you, whether your family is inside any sort of firm or that they own more than 10% of a company. If you're any of your family members, which I'm pretty sure you would know by now, but if any of your family members are brokers or they have a lot of ownership in a company, then you have to click on yes, and your account would automatically be a bit different compared to some other people, like an individual account. Your account would be seen as sort of like a brokerage account, but that's fine because it fits your style. Now, if you're not, you just click on no on that, and then it's going to ask for features that you want. You can enter whatever there, and it will click on review to see if all the credentials that you've entered were correct. And finally, I know that within this document, they'll ask you what sort of experience you have with options or stocks. To be honest, I would say, because these sort of accounts don't have a full accuracy to who you are and what you do, that you don't have to necessarily like say the truth. Even though, like, let's say you haven't traded options at all, you can just say that you have 1 to 5 years of experience. The reason why I'm saying this is because these accounts, especially with Charles Schwab, if they see that you have more experience, they'll be able to lend you more accessibilities with the account. And so this isn't a bad thing that you're doing or anything. It just gives you more accessibility with options that they don't allow other people. And the reason why they do that, which makes sense, is because they don't want people to lose a lot of money towards a lot of advanced features if they don't know what you're doing. But in this case, because you're learning from me, I have many, many years of experience, you don't have to enter that stuff. Okay. So yeah, once you do that, you just complete this document. But because I already have an account, they are going to ask me to do something else. So yeah, once you open a Charles Schwab account, I believe it will ask you to make a user ID and a password. Once you put on that, you should be able to make an account with TD Ameritrade. Okay, so once you've made an account with TD Ameritrade, then what you can do is go to Thinkorswim. So you just have to enter Thinkorswim, and you should get it right here, Thinkorswim. So what we want is the Thinkorswim desktop. So I hope that you're watching this video on a computer. If you're not, I highly recommend you to go on your laptop, pause this video, go on your laptop and enter with this, because this is where you can fully utilize the Thinkorswim platform. In the Thinkorswim desktop, because they actually changed this a bit, you actually have to go to Thinkorswim on Charles Schwab, and obviously you open your account on Charles Schwab, they should let you download it. Okay, so once you've downloaded Thinkorswim, then you can really exit out of Google. Now, I do remember that once you downloaded Thinkorswim, you can really search up the application, right? Thinkorswim, but it's going to show first the Thinkorswim installer. So if you click on the installer, it's going to show up the wizard installer, and it's going to ask you to agree with certain things. And then it's going to tell you what path you want to put the application in. So, you just do that yourself. Once you downloaded Thinkorswim, we can now open the application. Okay, so what you want to do now is, because you've never entered on Thinkorswim before, this part is going to be blank. So you want to enter the login ID that you have in TD Ameritrade that you made, and you want to enter the password of that TD Ameritrade account. So I'm going to enter mine, right? And make sure that you're in the live trading section. So I have it enabled because you can see right here. And yeah, once you've entered that, you can just click on login, and it should send you directly to your account in Thinkorswim. Now, I know that once you logged in, you're going to have this look differently. You might have it automatically on the education section. Don't worry, because we'll talk more what you should do. Going back to what we were explaining before, in Thinkorswim, there's an option chain. So the option chain is accessed whenever you click on the trade section. So if you click on this, it should show the option chain, and make sure that you're in all products, that way that you know that you're in the option chain. and you might have this look different. In my case, I'm just looking at Zoom, but whatever company that you're looking at, you're going to have this section look like this. Now, make sure that you have option chain open. So once you clicked option chain, you should have these different dates showing. In this example, we're going to open the March 1st option chain. Of course, you're looking at a different date, so whatever, just look at the first date that you have and open it. Once you've opened it, you're gonna look at something like this. Now, you might have these sections look different, but they should look really the same. I want you to understand what you're looking at, because you are looking at this and you don't even understand a clue what's going on, but it's simple. On this left section, you can see that it says calls. Every single time you're going to do a call, you're going to do it on this left section. And then for puts, the puts section is always going to be managed on this right section. Okay. Now, you also might have this entire window with less sort of numbers. I have it with more numbers because I have this strikes at 40. So if you click on this and you change it to 40, you should have this looking at the same if you kind of want to follow along exactly what I'm doing. So that's for calls and puts. You know that, okay, this left section is calls and this right section is puts. However, what are these numbers here? Like, what is this middle section telling us? Well, if you look at this left section is simply the date that you're looking at. So we're looking at March 1st, 2024. This is just going to be the March 1st, 2024. But for these numbers on this right section, you can see that there's numbers like 54, 57, 64. But what do these numbers mean? What does this mean? And you can see it's under something called strike. What does that mean? Well, a strike in options is not like a strike warning like baseball. Like it's not like a warning that you got strike one, you have to be cautious of the other strike. That's not what strike means in options. A strike price in options is basically a price where the option will behave similarly to the stock's price with 100 shares. Okay, let me show you in detail what that means. Right now we're looking at the stock Chipotle, and if we were to buy a call in Chipotle, let's say that our call option has a strike price at 2,720, so right about here. What will happen is that if Chipotle goes past this strike price, that's 2,720, remember that, as I said before, right over here, that a strike price is where the option will behave similarly to a stock's price with 100 shares. So once the price passes through the strike price, what will happen is that for every $1 increase in the stock for calls options, the option price will move up by $100, because for every $1 increase as a strike price will move similarly to 100 shares of the stock. So, if the stock moves up by $1, and because one contract of an option is 100 shares, $1 and 100 shares is $100. And then for put options, it's similar. If the strike price of this put option is at $70 and the price goes past this $70 strike price, what will happen is that for every $1 decrease, that option will increase in value by $100. Okay? Now, having this in mind, let's say that Microsoft, we decided to place a put option. So we're betting on the downside of this stock. We're betting that Microsoft can go down, and we're betting that Microsoft can go below the strike price of $400. So we're buying puts in this scenario. We're not selling, because selling bets on the upside. We're betting on the downside. So we're going to buy a put, and we're going to buy a put at the strike price $400. Now, if Microsoft goes down by $10 to $390, what will happen is that we actually made $1,000. $1,000. Now, you might be saying, how is that possible though? That's a lot of money. I mean, that's only a $10 decrease in a stock. Yes, but remember that options, as the price goes beyond the strike price, the options will behave as the stock with 100 shares. So for every $1 decrease for puts, that option will increase by $100. So what that basically means, do the simple math, is that if this stock goes down to $10, then your option will increase by $1,000. Now, you can see that this is very powerful, right? That's why I said that the elements that you see in options is that it's quick and that it also has a lot of gains. Now, we'll go about how it's cheap, but you can really see these two attributes. Now, you might be scratching your head and thinking like, this seems very powerful, but this still does not make sense. Then why don't a lot of people trade options? Like, what's the catch here? Because of course, not everything is perfect. Here's the deal with options. The thing is, because options are so quick and they gain very fast, that they're obviously dangerous. They're dangerous of how quick they are, that if you aren't using them cautiously, you can get really hurt, which is the reason why some people who trade options lose quite a bit of money because they don't use it correctly, right? But the thing is that you should understand is that professional traders like myself, and the point of using options as a professional trader is that you manage your risk systems correctly in order to avoid those dangers and actually to benefit from those dangers by managing your risk system. Okay, that's what professional traders can do, and that's the key of utilizing options. It's by managing and manipulating the risks that you see in hand. Okay, so that's it for lesson 1 as of today. On the next lesson, we'll talk about exactly how to use these risk systems and to talk more deeply of how to trade with options.